Hello and welcome to the Business Insurance webinar brought to you today by Sica Fletcher. I'm Mindy Zisman from Zisman Media, and I'm thrilled to be here moderating today's webinar. Our topic today is 2025 Insurance Broker M&A Update, navigating the opportunities and challenges. In a minute, I'm going to hand it over to the Sica Fletcher team, who will share a bunch of data, market trends, and we will have time for Q&A at the end. In your control panel, as attendees, we would love you to add in questions, and we will have a Q&A at the end. To be able to see the slides as clearly as possible, because you'll see there's tons of really amazing data that we're sharing today, you can please maximize the screen so that you have a chance to be able to see everything as close up as possible. We are delighted today to have a number of folks from Sica Fletcher. We have Matt Beiser, we have Michael Fletcher, and we have Pete Herman. I am going to hand it over to Pete to get started and tell us about, the 2025 Insurance Broker M&A Update. Pete.
Thanks, Mindy. First off, I'll apologize. We seem to have had some technical difficulties, so you won't be seeing our smiling faces today. But hopefully you'll still find this, very enjoyable and informative. So today, Mindy, if you don't mind flipping to the next slide,
Sure.
We'll be covering quite a few topics. We'll start with a little bit about our firm and what we do, and I'll pass it over to Mike Fletcher for an overview around interest rates, multiples, and agency valuations. We'll then go into a holistic summary of the insurance brokerage M&A market in 2024 and how that compares to prior years. I'll then turn it over to Matt, who can cover how the landscape has changed over the past decade and how that's created some key opportunities for both buyers and sellers. Mike will then discuss the impact of tariffs and the recently announced Gallagher and Assured deal and the impact that both of those have had on the overall M&A market. We'll then close with our outlook for the remainder of 2025 and beyond. And as Mindy mentioned, assuming we haven't taken too long, we'll save time at the end for some Q&A. All right, you can go to the next slide, Mindy. Great. So, a quick introduction into our firm and what we do. So we are an M&A advisory firm. We were founded 11 years ago and specifically focus in the insurance brokerage space. In the last decade, we've done more than $18 billion in aggregate transaction value and nearly 350 sell-side transactions in this space. We've consistently been ranked as the #1 advisor in the industry by S&P Global by deal count, and last year we advised on 104 deals. We're also the first and only boutique advisor that's advised on billion-dollar-plus transactions. We've helped put together multiple recapitalization events in the industry. You can go to the next slide, Mindy. So why am I telling you this? I think it helps with the presentation today because we have a lot of great data that we want to share with you. For example, in 2024, we ran 53 sell-side transactions. In each of these transactions, we received between 8 and 10 bids on average. The result is 400 plus data points from last year alone, which we think gives us really unparalleled insight into valuations and activity in the insurance brokerage industry. In addition, we've advised on 50 plus buy-side and financial due diligence transactions, and many of those did not have an advisor on the sell side. This also gives us a unique perspective really to compare and contrast transactions that included a sell-side advisor, either us or a competitor, versus the transactions that were self-represented by the sellers. To give you a sense of the deals we were involved in 2024, the average transaction value was around $30 million and covered the whole gambit of the insurance brokerage world, from retail to MGUs and across all segments, core P&C and employee benefits agencies to more non-traditional businesses like enrollment firms, life insurance GAs, as well as even an insurtech platform. So again, we've seen a lot and covered a lot of the market, and that really gives us some deep insight into the space. I'll now turn it over to Mike to give you an overview of interest rates, multiples, and agency valuations.
Great, thanks, Pete. Hello, everyone. I'm Mike Fletcher, and thanks for joining us today. So we have a few things we want to go over with you today, a lot of good data. But to get started, we're going to jump right into agency valuations. And so we can't talk about agency valuations, obviously, unless we really talk about multiples, and we also need to talk about interest rates. So we'll go to the next page, Mindy. So, at least once a week, I get a call from someone asking me the latest update on insurance agency multiples. And when someone asks about multiples, I typically respond by saying a multiple of what? In other words, what's the number that we're applying the multiple to? And the response is typically, well, the multiple of EBITDA. And I would then say, well, whose version of EBITDA? And you can see how this leads to even more questions. So while everyone is focused on the multiple, they're missing the most important part of the equation, and that's the multiple of what. In fact, we would argue that applying the multiple to what you're applying the multiple to is far more important than the multiple itself. And Matt Beiser will share some examples of that later. But in the meantime, where do these multiples even come from? Well, very basic. A multiple is the inverse of rate of return you're expecting on your investment. So, for example, if I take 10 times a 10x multiple and divide it into 1, I get 10%. So if you pay 10 times for EBITDA or earning stream or cash flow or even a rental property, then you're expecting around a 10% return. So maybe if we go to the next slide. So with those fundamentals, we can now ballpark what an investor expects their return to be at any multiple level. And this chart shows expected returns from 4 times to 16 times. So real simple. If you're paying 4 times for something, a cash flow stream, you get 25% return. If you're paying 16 times for a cash flow stream, you're getting a 6.3% return. And so I want to highlight and pick on the 6x multiple, and let's just use this as an example. So if we take 6 times, and let's just say we buy an agency for 6 times EBITDA. Well, 6 times EBITDA, 1 over 6, it equals 16.7%. So that's your expected return. However, we're hoping for some growth of that agency, and with a hard market like we've been seeing the last few years, we're probably going to get some. So if we take the 16.7% return and we add 6% to that, that's the expected growth. We get a 22.7% total expected return. Now, you're probably saying, great, where can I get those returns and where can I find an agency to buy at 6 times EBITDA? It might not work today, and you might be right. When I started this business in 2001, I was asked to write a research report on Brown & Brown, who was a publicly traded broker even back then. This was just solely for me to get my arms around the insurance business, insurance industry. And in going through the public filings, I noticed that Brown & Brown at that time was probably buying 3 insurance agencies a month, sometimes even in a week. And what were they paying for them? Well, you guessed it, 6 times EBITDA. Now, this was in 2001. It's the start of a hard market. And given 9/11, we had that hard market right after. So let's just say agencies were growing 6%. So what were Brown's returns during this period? Well, you guessed it, 22.7% plus. And so if you were a Brown & Brown shareholder, how did that work out? Maybe you'll go to the next page. So here is the S&P return from 2014, 2000 up till 2007. Now I have 2 college age kids, and they tell me, if you just invest in the S&P, you get a 20% guaranteed return. And I try to explain to them that's not always the case. And if those are old enough to remember, this was the lost decade. This went on until probably around 2013. There were essentially no returns, even negative returns, for 13 years in the S&P. Well, that didn't matter for Brown & Brown shareholders, because at the peak they had gotten 600% returns of their money. And so when you really think about it, if you're buying assets and getting 22, 23, 24% returns, this makes sense, right? So, but when you have this type of result, you attract a lot of capital. So we'll go to the next page. So this is the 10-year treasury going from the year 2000 all the way up till today. And the way I think about insurance broker M&A, I think of it in different time periods. So we have what I call the pre-private equity time period, and that's around 2000 to 2007. Now we highlight there as Brown & Brown, but it wasn't just Brown & Brown. It was publicly traded USI, Hub, Arthur Gallagher. There were even banks in the mix, Bank of America, Wells Fargo, all these other folks doing transactions. Now, the key about these deals was these were typically unlevered transactions, meaning Brown & Brown and others are using the cash flow from operations to buy these businesses. So you're getting 22% unlevered returns. What would happen if you applied leverage to that? Now, up until that point, there wasn't much leverage in the industry because insurance brokers weren't seen as good credit risks to lend against. I mean, they have no real assets. But that changed in 2007, and that's what Hub and USI went from public to private in very large LBO or leveraged buyout transactions. Leveraged buyout transaction, essentially the buyers using debt to finance most of the purchase price. Now, the timing of those two deals could not have been worse. You're looking at 2007, the top of the stock market, wouldn't recover for quite a long time. And we're about 4 months away from running into the greatest financial crisis the country's seen since the Great Depression. Terrible timing for these deals. However, the deals turned out pretty well. Both Goldman Sachs and Apex Partners ended up exiting these deals in 3 or 4 years, making 2.5 to 3.5 times their money. So that got a lot of folks' attention. Hey, you're investing in an asset class using leverage in a terrible economic environment, and look at the returns. And then we started seeing a lot of other folks and private equity firms enter the space. So you'll see all the different names and timing of when they started. And I don't think we could even fit all the logos on here that are out there today. So I mentioned maybe 5 or 6 public brokers in this pre-private equity space. Today, there's about 50 total brokers looking to do deals. But notice the one thing, there was a silver lining with the great financial crisis. And that was we were entering a secular drop in interest rates. And if you're using a lot of debt to buy insurance brokers, what's one of your largest expense? It's interest expense. So as those interest rates went, you can see the 10-year treasury here went from 4.6% in 2007 to essentially zero, during COVID. And as a result, if you were paying 6 times EBITDA in the beginning of this chart, for an insurance broker, by the end, you were paying 11. So valuations just about doubled during the time period, attracting a lot of capital. Now, to the very right here, notice we have this, maybe perhaps a new time period, the past from 07 till around past 2 years. I call it the private equity boom. Well, now 2024, is it, do we see the strategics come back? And we have seen a couple of large strategic deals. NFP sold to Aon. And we'll talk about this later, but Assured sold to Arthur Gallagher. To me, it's probably the best deal in the past decade. And so do we see that start to take place where strategics start to take more market share? We'll see. Next page. And you could see back in 07, private equity made up about 10% of all deals. Today, that's about 75%. So does that change? We think that might. Next page, please. All right. So this is data from our database. Like Pete mentioned, we're doing, working over 100 deals a year. So these are deals that we have, live access to. And so these are multiples of deals we're working on. But let me give a caveat on what this looks like. So first of all, this goes quarter to quarter. We're taking, these are all our sell side deals, meaning each of these deals probably had 8 to 10 bids on them. So they're all sell side deals. The multiple is the multiple of what I should say is our version, that is Sica Fletcher's version of EBITDA. So it's our version. We're representing the seller, our client. We're representing, we're putting up our best foot forward for EBITDA, and that's what the buyer is applying the multiple to. And finally, this multiple represents guaranteed at close. We don't have earnouts baked in here or stock appreciation or all these bells and whistles if you can do certain things in the future. This is what our client's getting guaranteed. So the business falls apart the next day. This is the guarantee. So you'll hear people say they sold their business for 15, 16, 17 times. Yeah, they might have on paper, but they weren't getting that at close. So the guarantee at close is pretty important. And so you'll see here that back in 20, remember interest rates, in 20 just about hit zero. So we went from this 9.8 times guaranteed at close to 11.9, and I think our average for all of 2024 was about 11.6 times guaranteed at close. Now the ranges are probably from 9 to 14, 14 and a half, and the size of these are typically $1 to $25 million of EBITDA. So this is again live data. It's not us guessing at what the market is. This is really what the market represents. So let's go to the next page. Now there is a lot on this page, and we were a little nervous even putting it out there because we want to confuse people, but this page really is a great way to look at the insurance broker M&A market. This really tells you the whole story of exactly what's going on. If you understand the mechanics behind this, you can get a really good grasp of insurance broker M&A, whether you're a buyer or you're a seller. So this top blue line, that's the same line we just looked at. Those are our multiples. We're tracking them over each quarter from 2020. The middle line represents what the average debt cost is for mid-market private equity brokers. This is the average. So we call it, so for example, we take the 90-day SOFR, which is what borrowing rates are based on. That's the bottom line. And we add 450 basis points to that. I'll get emails later today. Hey, we only pay 300 basis points, or someone else pays 600. We're just trying to show kind of an average. So if you're borrowing, this is sort of what you're paying, right? This middle line on these highly levered deals. Now, let's go to, as an example, to Q3 2020. In the quarter before that, COVID broke out. World's in panic. A lot of deals still got done then, but the multiples you could see retracted. People got nervous, so multiples went down to 8.7. Now, remember we said if you're paying 8.7 times for something, well, that's an 11.5% return. So you were buying an agency getting 11.5% return. This excludes any potential growth. So you're probably getting some growth on top of that. But you're only borrowing at 4.6%. So that's a 7% spread between what you're making on your investment and what your cost of capital is for most of that. To me, that's called money printing. If you can do that, you're going to be printing money on your returns. And that's exactly what happens. So here's where the returns really get juiced up. And now you can see over the next 2 years, multiples go up, which means expected rate of return for investors comes down. And you can see the spread starts to get tighter and tighter and tighter. Now, in the second half of 22, the Fed raised rates. We had this, remember transitory inflation? Well, it turned out it wasn't transitory when you print $4 or $5 trillion and put it in the economy. So we had inflation. The Fed had to raise rates, probably the most rapid rate we've seen in Fed history. And then so what happens is by the end of 22, multiples basically peak at about 11.9 times guaranteed, and the spread is now gone. So borrowing rates went from 4.5% to 8%. So now there's no more spread on that leverage. So in 2022, I called, hey, look, we're going to have a bear market in insurance broker M&A. Private equity firms aren't going to take a negative spread, and you can't justify that. And I was 100% wrong. So it turns out, Matt and Pete will get into why this is the case. It actually turns out that deals kept happening at pretty healthy prices, and private equity firms continued to be willing to take negative spreads. Now, 2024, it's stabilized. So we're still doing deals and people are still taking the negative spread. I think this is unsustainable over the long term. Later on, you'll see why I'm bullish on this. Now, by the way, at the very end here, you can see interest rates came down about 40 basis points in Q4 24, and that actually, reduces the spread and it provides a lot of relief to brokers. But we think it's non-sustainable. We're kind of surprised that this continued on. But Pete's going to get into exactly why that happened and tell you about the market. Next slide, please. Pete.
Great. Thanks, Mike. As Mike said, let's now discuss, what actually happened in 24, right, and how that compares to the last few years. So this is, think of this like the volume slide, right? We want to show kind of overall transaction volume in different sectors and how we've kind of split it up. We'll talk about here. So starting in the chart in the upper left, you can see that overall deal activity in 2024 was slightly higher as compared to 2023, which had come down from the peak in 2021. It is worth noting 2021 was an outsized year in many respects, as you'll see on the other few charts on the slide as well, in large part due to the push to get deals done and closed by the end of the year. If you remember, there was a lot of worry about potential capital gains rate increases, which resulted in really this mad dash to get things done in 2021. Of course, that capital gains rates did not change, but it was certainly a valid fear at the time. So we would think you'd probably see some of those deals into 2022. So those would be about even, all else equal. You'll also, staying on this slide, you also see that there's a relative inverse correlation between transaction volume and the 10-year treasury rate, which again, Mike discussed in detail earlier, but we'll continue to talk about as we get further into the slides. Moving to the chart in the upper right, for our deals specifically, we followed the overall trend in the market, albeit with a less dramatic drop in, from 2022 to 2023. Again, we also had a slight increase in 2024 in deal count as compared to 2023. Again, with all this data that we had from the deals that were involved, this consistently represents a substantial portion of the overall market. And again, we feel that gives us exceptional real-time and representative data into the market. In the lower left, you'll see total acquisition volume for members of the Sica Fletcher Index, which is comprised of 22 of the most acquisitive buyers in the space. As you can see, the SF Index represents about 70% of total deal volume in the space for the last 5 years. And again, we have great relationships with these buyers and get to see their data. And again, another set of data points for us to analyze. Interestingly, in the bottom right chart, you'll see that the SF Index deal volume decreased about 6% from 2024 to 2023, but the acquired revenue decreased by almost 27%, which really that just means that deals done in 2024 were smaller on average in terms of revenue size versus the deals done in 2023. We can move on to the next slide, Mindy. All right, so this slide here, and Mike has already kind of alluded to where multiples were, but I really like looking at this slide because it takes a look at the average multiple for those deals over $1 million in EBITDA. Obviously trending up pretty sharply from 2020 to 2023. But in 2024, we really saw the valuation stabilized, right? And they did tick up ever so slightly from 11.5 to 11.6. But again, still at historically high levels. And that's, from 2020 to 2024, that's a 22% multiple expansion. So we can go to the next slide. So furthering on the multiple discussion, here we have a comparison of advisor-led deals versus no advisor, right? Again, for deals in excess of $1 million of EBITDA. Pretty clear, right, from the gray line that deals without an advisor do trade at a substantially lower multiple, right? Approximately 2 times lower throughout kind of the last 5 years. It is worth noting that in 2022, there was actually 2 outliers that really brought that number down. All other things equal, we think that would be in kind of that high 9s to 10 range and consistent with the overall trend. We can move to the next slide. So this is the same slide, but now we're looking at multiples of deals with less than $1 million of EBITDA. Similarly to the larger agencies, sellers using an advisor do bring a substantially higher multiple than deals without an advisor. But I think it's also worth comparing, these smaller deals do tend to trade about 2 times lower than their larger counterparts. And Matt will actually go into discussing how that's really an opportunity for the buyers in the space. So we can go to the next slide, Mindy. So this is actually the same slide that Mike had shown earlier around the leverage returns, but I really like this slide because it does a great job of explaining what's going on in a visual way. As Mike had stated, right, really starting at the end of 2023, the spread, right, between expected return and cost of debt has flipped. And interestingly, this spread has stabilized throughout 2024. So, the investors have, I guess, come to terms with that, right? You can see there was some fluctuations throughout 2023, but 2024 has been really consistent, right? So multiples have stayed high despite interest rates being high. And as Mike said, we really don't think that is sustainable in the long term to have that negative investment spread. And we think, really the Gallagher and Assured deal, and that it happened at the value that it did, is an indicator long term for what we expect, multiples to do. So we can go to the next slide, Mindy. So why has this happened, right? Why are we still seeing this negative investment spread, and why is it really stabilized in 2024? We attribute that really to three main macro trends that have led to these unique conditions. The first is premium inflation. Overall, second is elevated buyer demand, and how that's continued in this space, if not grown over the last 12 months. And then lastly is the institutional capital dynamics in this space. So we can go to the next slide. So this is a really interesting chart. So a lot of the investors look at, really two avenues for growth, right? There's inorganic growth through M&A, doing acquisitions, and then there's organic growth, which is growing the revenue of the businesses that they own. Looking at this, one of the reasons that there's so much institutional demand, as we'll talk about on really the next two slides, is this almost built-in organic growth, right? As you all know, insurance isn't getting any cheaper, right? And so in 2024 alone, the P&C premium growth on average was almost 10%. So if you think about that, as long as you're maintaining your client base, right, and net neutral from a client count, you should be growing at almost 10%. And that's obviously very attractive to these investors. And I think to illustrate that point, 2024, there was a major milestone. That was the first time that we hit $1 trillion in US P&C insurance premium, right? Mainly driven by this inflation that we're seeing here. So let's move on to the next slide. So the second key driver is a continued increase even in the buyer demand. So back in 2007, there was only a handful of active buyers in the space, right? All names I'm sure you're familiar with, you can count them on one hand, right? As of the end of 2024 and into 2025, there's more than 50 active buyers. They're all vying for the same acquisitions, right? And there's new entrants coming in regularly into the space, finding a private equity partner, family office, and trying to do what all these others are doing. Obviously, this is a very competitive marketplace, right, with all of these buyers. And in spite of the rising cost of capital, we're still regularly seeing those 8 to 10 offers that we talked about earlier for the sellers that we represent. So let's go to the next slide. So the last driver that's really been key to these market conditions is related to the dynamics surrounding the institutional capital in the space. Related to the previous slide is the overall demand. The insurance brokerage world, as many of you know, has really been a darling in the PE world for the past decade plus. And any firm with a focus in the financial services sector either wants to own or acquire a platform in the insurance brokerage space or already owns a platform that they're actively looking to grow. In addition, I would say PE-backed brokers in general have a substantial amount of dry powder to be deployed for M&A. It's key to their strategy of growth to continue to do acquisitions, right? And again, you see the competition from the previous slide. This competitive process has helped keep those multiples at the historic highs that they are. The last thing I wanted to mention here on the institutional capital dynamics is what we refer to as multiple arbitrage. What this means in short is that buyers and investors in the space, so these PE-backed brokers or the public companies that we've been talking about, generally trade at higher multiples than the agencies that they're acquiring. For example, if there's a particular buyer that's valued at 15 times EBITDA, if that buyer acquires $1 million EBITDA agency for 10 times EBITDA or $10 million, the buyer's overall enterprise value increases by 15 million. Now, of course, we subtract the 10 million in cash, debt, stock, other consideration for the purchase price, but that's still a net increase in enterprise value of $5 million. So again, that's why this inorganic growth through M&A is so key to these strategies. So again, we think that really these three drivers, premium inflation, buyer demand, and the institutional backer dynamics have really contributed to what we think of as the resiliency of the market and have kept the agency valuations where they've been. I'll now turn it over to Matt, and he can discuss how the landscape continues to evolve and the opportunities that that's creating for both buyers and sellers.
Good afternoon, everybody. This is Matt Beiser. Up until this point of the presentation, Mike and Pete have demonstrated how robust the insurance brokerage M&A market currently is. And as Pete showed, we are currently on average at the highest multiples we have ever seen in the history of our industry. Having said that, that's only part of the story. We entitled this presentation, Navigating the Opportunities and Challenges. So what specifically are the opportunities and the challenges we're talking about right now? To understand that, we have to understand how the landscape has changed. The bottom line is the landscape has become much more complex for both buyers and sellers in the last few years. And there are two elements that make it that have made the environment much more complex, as we've outlined. First, the literal explosion in the number of private equity sponsored brokerages we see in our industry. We've gone from 5 acquirers historically to over 50. And secondly, the rapid escalation of interest rates a few years ago really altered how private equity sponsored brokerages and their investors utilize their acquisition strategy to create the returns that they need. So let's go to the next slide. And you can see we've given here 4 of the ways that the M&A market has shifted, has become more complex over the past few years. There's a lot of items that we could highlight, but I think these 4 are really illustrative of what we're talking about. The first is buyer rotation, and I'll explain what that is in just a second. The second one is the evolving mix of cash and stock that sellers are receiving at closing. The third is transaction structures have become differentiated among different acquirers. And I'm using the growth bonus, which is a simple example, as illustrative of that. And then the fourth one is that the private equity sponsored acquirers use evolving and different capital structures, which have implications for sellers. So let's go to the next slide. The first of these is buyer rotation. And what we mean by buyer rotation is that some buyers have become more active on a relative basis over time, and others less so. What we did in this slide is we took the 22 acquirers that participate in the Sica Fletcher index. Those buyers every quarter represent 70 to 80% of the entire mergers and acquisitions market. And what we've done is we've ranked them by the number of transactions that they've done. The dark blue is 2024. So a lower number means that a higher rank, really. And then what we did is we took the lighter number and we compared where those firms were in 2021, just 3 years ago. And so if a firm was had a higher number, it means that they've become relatively more active. And if they have a lower number for 2021 than where they are now, it means that they've become less active. And so what this really shows is that there are buyers that have slowed their acquisition programs and other buyers have stepped up. For example, if you look at IntZone, IntZone is now third. 3 years ago, they were 16th. Keystone is now 6th, where they were 14th. And Alchemy now 9th, where they were 18 3 years ago. So this has made navigating the M&A process even more complicated. And to make matters worse, there are firms on this chart, if you did the same thing for 2022 and 2023, they would have very different positions. So some firms slowed their acquisition program up for a year or two and then speed it up. So this has made navigating the M&A market much more complex, because the question is who's buying aggressively, who's slowed down is critical. Let's go to the next slide. Another thing that's happened is that the amount of equity used in the transactions has increased. So at closing, typically a seller receives a combination of cash and stock. Historically, 2021, before the interest rate rise, the average was about 80% cash at closing and about 20% stock, where the range was 15 to 25%. Now what's happened is that the buyers are using a higher proportion of stock. It makes sense. When debt was cheap, when it was cheap to borrow, they were able to use more cash. Now that cash has become more expensive, they're using stock. So we're seeing a range of anywhere between 20 and 40% of stock in our transactions today, with the average shown here. Now, I want to make the point, and it's an important point. This is not necessarily a bad thing. It actually might be a good thing that sellers are receiving more stock. We've argued for years that selling agency owners should take as much equity as possible, because this equity historically has appreciated in value at a far greater rate than virtually any other investment you could find. Having said that, as Pete showed, there are over 50 private equity sponsored brokerages. And superficially, they sort of look the same, but the reality is that the way that their equity will perform in the future will differ on a company by company basis. So I think this is another example of how things have become more complex. Let's go to the next slide. The third way that insurance brokerage M&A has become more complicated is because transaction structures have diverged a lot more now than they have 3 or 4 years ago. Some sellers think that once they get to a letter of intent and once they know the EBITDA multiple and things are signed up, that's it, it's easy, there's not a lot else to do, and that's obviously not the case. And so what we've done is we've used the example of the growth bonus as to how transactions have become more variegated over time. The growth bonus, just to make it clear, is the amount of cash, additional purchase consideration that's typically paid over the first 3 years following a transaction. So normally 100% of the value, absent extenuating circumstances, is paid day of closing. And then there's additional amount of purchase price predicated on the growth of the business paid over 3 years. And I just wanted to point out how different these can be. So for example, the growth metric can be based, some acquirers base their growth metric on revenue and others base it on EBITDA. Some have one payout at the end of year 3. Others have a payout every year at the end of year 1, year 2, and year 3 with a true up in each year. Some of them have a fixed schedule where if you grow to X, you get Y, and if you grow more than that, you get more. Others simply say that it's a multiple of growth, so you might get 5 times the growth in EBITDA from the pro forma, or 2 times the growth in revenue, for example. Some of them start from the number in the pro forma as a threshold, and you get paid above that. Others have a growth factor, so you have to grow 3% or 5% or whatever each year before you hit the growth bonus. Some buyers cap the earnout proceeds, and some have uncapped proceeds. So it just makes the world, if you're a seller, more complicated because all these growth bonuses really differ. Now, let's go to the next one, which makes life even more complicated. And this is the evolving capital structures that are used by private equity sponsored brokerages. This is the third reason why the market is more complicated. This is a difficult topic to understand, and to truly understand it would take a full webinar. But it's important because if you're exchanging as a seller your equity interest in your agency for a combination of stock and buyer equity, you need to know when, if there's a liquidity event for the buyer, when and how your proceeds are calculated. So the question becomes where in the cap table your equity stands. In the classical capital structure, there were 2 parties really entitled to the proceeds of sale. The first was the senior lender, which was of course entitled to its principal plus interest. And then the following was the common equity. The common equity got everything after that. And the common equity typically included the private equity investors, senior management of the buyer, and any sellers that had sold their equity into the business. Now, we've seen a number of examples of a much more complicated or advanced capital structure. What we mean by that is we have the senior debt on top, then we have a layer of mezzanine debt, typically at a slightly higher rate of interest. Then we might have 1 or more classes of preferred stock, perhaps from an outside investor, or perhaps from insiders, management, and folks that sold their businesses. Often this preferred equity is paid in what's called PIK securities, meaning payment in kind. So folks don't get paid in cash, they get paid in additional securities. And it's after all of that, the common equity gets their cash. Now, what that means is that there are multiple classes that get access to the proceeds before the common stock receives a penny. Now, frankly, we're not making a value judgment about which form is better. Under certain scenarios, the classic is better. Under certain scenarios, the advanced is better. But what's clear is that the risk and reward of each are somewhat different. So let's go to page 30, the next page. And so this more complicated market presents both opportunities and challenges for acquirers and for sellers. Let's talk about both. The page 31 talks about the buyers. Buyers have 2 issues. One, valuations are at an all-time high, and there's a lot more competition for the same properties. So a solution is to focus on smaller agencies. Smaller agencies, as you can see, sell at a significantly less large multiple, over 2 turns less, and that is a benefit to focusing on the returns. But there's an even better solution, and the better solution is to focus on agencies without an advisor, because those agencies sell, as Pete showed, at a significant discount to agencies with an advisor. For agencies under $1 million of EBITDA, they sell at approximately 7.8 times. So what we often recommend to buyers is that they focus on what we call friends and family acquisitions, meaning acquisitions of smaller agencies that aren't represented by a buyer, because those agencies typically sell at a lower multiple, and as we'll see in a minute, they often sell at an EBITDA calculation that's less than would otherwise be the case. So let's go to the next page. What are the opportunities for sellers? I think to understand this, you really have to understand that other than the EBITDA multiple, there are three elements to maximize value in a sale. The first is fixed. The second and the third are absolutely not fixed. The first is the broker characteristics, the type of business, retail, wholesale, MGA, specialty, TPA, whatever. The size, because the bigger the firm, the more the EBITDA, the higher the multiple. Growth parameters are very important because buyers are focused on organic growth as well as inorganic growth. And then management quality. These are all elements that are sort of fixed. But the next one is really important, and that's the multiple of what? Let me say what it's not, first of all. The multiple of not is not actual financials. It's not historic EBITDA. It's not future projections. It's that magical item called pro forma EBITDA, which would take an entire webinar once again to talk about. But really what that means is taking the last 12 months of actual financials and adjusting them for a host of items, one-time expenses that won't exist following a transaction, normalizing compensation, that type of thing. And the calculation of this item is critical. Now, sellers often think they can do this analysis by themselves or use their accountants or attorneys, but the reality is that these folks don't really understand the rules of the game. They don't understand how intricate the calculation is, and often they put themselves at a competitive advantage to buyers. Let's go to the next page, which shows two hypothetical brokerages to illustrate how important this calculation is. These are two firms, both with 4 million of EBITDA. The first one has a pro forma EBITDA of $1 million, meaning it has a 25% margin, 1 million over 4 million. Let's say it sells at a 10 times multiple. So obviously it sells at 1 million times 10 or $10 million, okay? That $10 million very simply correlates to 2.5 times revenue. 0.25 times 10 in this example is 2.5. Let's take the same size, broker B, which is 4 million of revenue also. Let's say it has a 40% margin. If it sells at 10 times, that of course it'll sell at a 16 million purchase price, which is 60% more than broker A. It also, if you do the math, 0.4 times 10, it sells at 4 times revenue. So that's a hypothetical example. Let's go to a real life one, which really shows how complicated this is. Let's go to the next page. Now, in December of last year, Arthur Gallagher announced it entered into an agreement to acquire Assured Partners for a gross consideration of more or less $13.5 billion. Now, there were scores of M&A professionals working on this deal. The deal was in the public domain. Actually, there were a lot of numbers in the public domain. And yet the EBITDA multiple that this firm sold at is still open to debate. So, Mike, would you take a few minutes and walk us through what the EBITDA multiple or multiples were that AJ Gallagher paid for Assured?
Yeah, sure, Matt. Thanks. I think the answer would be, well, it depends. Right. So if you're Pat Gallagher and you're up in Chicago, maybe you're at the local country club and playing golf with friends, and they said, hey, we noticed you bought Assured. What did you pay for that? He could probably say, well, we paid 11.3 times EBITDA for it. And he would be right. Now, at the same time, if you're Jim Henderson or Randy Larson and someone asks you, hey, what did you sell Assured for? You could say we sold it for 15 times EBITDA, and they would be right. So what's interesting here is the EBITDA multiple is open to anyone's interpretation, but so is the actual EBITDA. Remember the EBITDA of what? What are you applying that multiple to? That's open for interpretation, as it is with every single deal. But here, what's great about it is in the public. This is public data that they put out there. So if you go to this top left here, we have this adjusted EBITDA. And, so Assured, it looks like they had about $895 million of actual EBITDA, probably GAAP accounting EBITDA, these audited financials. And then it looks like when a short was out there in the market, they had this pro forma EBITDA that Matt was mentioning of a little over $1 billion. Well, Gallagher, which I thought was very interesting, goes in there and they do this in public documents. They said, well, we didn't really agree with the $1 billion of EBITDA. Our version would be 938 million. But then I guess maybe to get the deal done or for whatever reason, Gallagher then says, well, if we take our own synergies, cost savings and other things we can do with this great asset, we think this is going to generate $1.1 billion of EBITDA for us. There's also this deferred tax asset. We're not going to get into the weeds on that. And so Gallagher's view is, they probably paid about 11.3 times for this. And so down below, so multiple of what? Well, the multiple of what is open to interpretation by 22%, right? 895 to 1.1. And the multiple, that's open to interpretation. And, we've got from 15 even all the way down to 11.3 times. So this is just a great example of what's happening with even a smaller deal. So if you have $1 million EBITDA, believe it or not, these things matter, right? So if your multiple of what is 22% higher or lower than what someone else views it as, that's going to change, the size of the deal if the multiple changes. So these are all critical points Matt's bringing up, and we think that the Gallagher Shore deal is just great info for people to look at.
Thanks, Mike. So when you look at at these multiples, and this is in the public domain for the most visible transaction of the year, effectively, you can imagine for the normal run-of-the-mill transaction how complicated and open to interpretation the numbers are. And it's really interesting. So my best advice to you is that when your friend down the street tells you that he sold his agency for a super high number like 16 or 18 times EBITDA, frankly, you should smile knowingly. And if you want to be provocative, you should simply ask him over what time frame he's getting this so-called 16 times. And, he's getting the 16 times over what number exactly? Because the bottom line is, as we always jokingly say to clients, 16 times 0 is still 0. So both variables are very important here. Let's go to the next page. So we've talked about the buyer characteristics as being fixed. We've talked about the pro forma EBITDA is critical. The third element that's really critical is the competitive process. Assuming the pro forma EBITDA is calculated the proper way, what's the best way to drive value in a sale transaction? It's a competitive process. And there are a lot of advantages to running a competitive process. The seller plays offense, not defense. The seller's in the driver's seat. The seller controls the numbers. The seller calculates the pro forma EBITDA, does not leave it to the buyer, and the seller controls the timing. The bottom line is a competitive process creates a sense of pressure, and that pressure makes potential buyers pay up. Frankly, we see it all the time. But there's another element to this that has nothing to do with the numbers. A competitive process enables the seller to make an informed decision and explore the market by talking to all types of buyers, sizes, personalities. The seller can come to an informed conclusion as to what type of buyer to partner with. After all, we always give our clients the same advice. Don't just focus on the money. We get our buyers our sellers the best transactions that we can, but picking the people is really important. After all, most sellers don't want to retire immediately or leave the industry. Most want to reposition their business to continue to grow, take some chips off the table, but provide the opportunity for their business and their people to grow even faster and succeed in the future and create opportunities for value for both themselves and their people. So those are the three elements I would say really maximize the opportunity for sellers. And with this, I'd like to turn the presentation back to Mike to discuss what we believe the outlook is for 2025 and beyond.
Great, thanks, Matt. So we're getting to the end presentation. So Mindy, you go to the next page, please. So 2025 Q1 has actually been a strong start, I think, for the market and for us. So we closed 19 deals this first quarter, 10 on the sell side, 9 on the buy side. Here's the average multiples. And again, so on those 10 sell side, we had about 10 offers per transaction. So it gives us, 100 different data points to look at. So we'll go to the next page. So, and here's the average multiple. You can see the multiples have come in a little bit, right? From 11.6 to about 11.3. Some of this is data noise, but there's been a little bit of softness in the multiples, but not much. Maybe we'll go to the next page. Back to this, this famous page. We think that tells it all. What happened here is this: the most interesting part is to the right. That negative spread that we talk about, that's disappeared for now, and you could see the bottom interest rates on the bottom. It's gone from 5% to 4.3. Remember, we were up as high as almost 5.5% last year. So if you're a public broker and you have, a few $1 billion, or excuse me, a private broker, you have a few $1 billion of debt out there, and you're paying 5.5%. Now you're paying 4.3. That's actually a lot of cash flow you're freeing up to do deals with. So we think this going forward, this is about the spread. Spread's not sustainable over the long term. And if we get interest rates going lower, it'll become, these valuations will be sustainable. So, and at the end, we have a view on where the market's going. We'll go to the next page. So, here's our outlook for 25. What happens going forward really is going to depend on how this, how this slide plays out. Last fall, the Fed cut rates 50 basis points, and that provided a bunch of relief for brokers. And the negative spread is gone. So, there's really 3 things that could happen here. There's this status quo. These are economic outlooks, right? The status quo is we continue with really the last administration's policies, and we're running 7% budget deficits as a country. That's typically what you run in a wartime. That's not sustainable. So if we continue that way, and I don't think we're going to, but we're going to get growth, sure. We're going to get elevated inflation, but we're going to have these 10-year Treasury yields probably 4.5% higher, and the Fed's not going to change short-term rates. So to us, the status quo is, it's bearish for private equity buyers because of that negative leverage we've been talking about the whole time. It's bearish for agency sellers because you're going to get pushback on multiples coming down. It's probably neutral for the strategics, like the Gallaghers, like the Willis, Marsh, Brown & Brown, because they'll be able to buy assets for lower pricing, and they could also borrow for much lower interest rates. Now, we think that if you just follow the administration, they say don't fight the Fed. Well, you could also say don't fight the Treasury. So what's interesting about the new administration, it seems like they're bullish for business and insurance broker M&A. But I think what we're most impressed about with Trump and his cabinet pick is Treasury Secretary Scott Bessent, who in my opinion is probably one of the smartest Treasury secretaries we've ever had. He was a part of the team that included George Soros, ironically. They put a short against the British pound, essentially broke the pound and broke the British bank, and him and Soros made $1 billion in one day. My point is we never had a macro hedge fund manager run the Treasury, and this is a guy that understands macro flows. And in both him and Trump, remember Trump's first administration, he kept talking about the stock market. Notice he's not really talking about that lately. Him and Trump have made it clear they want the 10-year Treasury rate to drop to 3%. And to do that, they need to kill inflation and slow the economy. I think, in my opinion, it may be controversial, they even want the stock market to come down, which it has, to slow that wealth effect and kill inflation. Now, Bessent talks about this 3-3-3 plan, and he's talking about 3% growth, 3% deficit, a 3% deficit versus 7%. And the other 3 is actually another 3 million barrels of oil a day. And they have this sort of this Goldilocks economy, and that's what they're shooting for. In that case, with the 10-year Treasury at 3%, it's really bullish for all buyers and sellers. We have a growing economy. This would be real bullish. But what about the tariffs? Now, days after the tariff, we actually put a piece out real quick, and it's almost like you have to change these pieces every day. But when they announced the tariffs, the market, stock market went down about 10%. But Treasuries went from 4.3 to about 3.9, so it was almost happening instantly. I believe this is all part of their plan. Now, what wasn't part of the plan was last week when the 10-year and 30-year Treasury shot up the most in 40 years. The speculation that the Chinese are dumping treasuries. Now, I think this tariff turmoil will get behind us sooner than later. But what's interesting, let's just say it doesn't. Let's take the worst case scenario. So let's just say we have tariffs, we have no growth or even slightly negative growth. We have high inflation, stagflation. Well, in that instance, the 10-year Treasury is going to stay high about 4.5%. But those short-term borrowing rates, my guess is the Fed would cut. If the economy's not growing, the Fed's going to cut into, even with inflation. This is why it's a terrible, terrible move for our economy. But even with inflation, I think short-term rates would go down. So now we have elevated inflation, which means insurance premiums are up, and we have reduced short-term rates, which means borrowing cost for insurance broker PE is down. I think this would be very bullish for PE-backed buyers. I think it's bullish for sellers. I think it's neutral for strategics just because now they have more competition with these PE-backed brokers. So we believe, just from the deal activity we've seen so far, we think there's still a ton of capital out there. I think there's when we started this 10 years ago, 11 years ago, it was $300 billion of private equity capital. Today it's like $3 trillion. So there's plenty of private equity brokers, private equity firms that need to put the capital to work. And so we think we'll still see, this pretty elevated demand. So with that, that's our outlook. I want to thank everyone for joining us today. And what I'm going to do is I got some questions sent to me. And we got a lot of questions that I'm going to try to answer. And Mindy, you just let me know how much time we have left. And I'll start rattling off some questions. And we could always, if we don't get to your question, we're more than happy to shoot us an email. We'll answer it. Or those folks that have their name in here, we'll be able to answer some of those questions.
Yeah, we have about 20 minutes left, Mike.
Okay.
And I wanted to just let everybody know first, before we start the Q&A, that all the attendees here today and anybody who did sign up for this webinar will, of course, get the recording of this webinar in their inbox in the coming days. And obviously, on behalf of Business Insurance, we are so thrilled with all the amazing information and transformative and informative data that you shared here from Sica Fletcher, Mike. So thank you so much. And there are a number of, like you said, really great questions on what you guys had to say in the Q&A here. So we'll take that for the next, 20 minutes or so.
Great. So yeah, wow, some of these are some pretty in-depth questions. So we'll start, let's see. So we have a question here. What could be expected, or what do typical events look like for a seller after a sale? Example, number of years expected before an event, requirement scenarios for cash or stock. So in our practice, I think our typical principal last year was somewhere in the early 50s. So we're not typically getting folks that want to sell the business and hang their cleats up. For many of our clients, it's about repositioning the business. So what does a deal look like post close? That depends on who you do the deal with, obviously. But there's some buyers that are very they're new, they're small. They're ground floor opportunities. They don't really have everything figured out yet, and essentially you're taking on a partner to help them grow the business. Then there's other folks like you look at Marsh and Gallagher. These are mega firms, so life could be different. But I think it's from our perspective, if you're considering what you want to do a deal, you need to figure out what is it you're trying to accomplish after the deal, and for everyone that's different. But there is, with 50 buyers out there, there's basically a deal for every seller out there in terms of what you're trying to accomplish. So hopefully that covers some of that. Let's see. All right, actually this is a pretty common question. When or how long do PE firms look to have an event? Or as a seller to a private equity backed firm, how long should you expect between events? So this is a great question. I think our average client probably took, if they're doing a private equity backed deal, they probably took 15-20% plus in stock last year. And if they did, so what this question is, well, you have stock, you can't sell it publicly. How do I get out of this at some point? How do I get liquidity? Now it's important to keep in mind that the private equity firm, the way they ultimately get paid is through a liquidity event. So they're incentivized to get liquidity. So when do they do that? Well, it really depends on the life cycle of that investment. So if you join a private equity partner that had an investor come into it 3 or 4 years ago, you're going to probably have a liquidity event pretty soon. But if you started, right as soon as the private equity firm got started. It may be a couple of years. So I tend to think, between 3 and 5 years, 5 years being max, 3 years probably being average is when you might get that liquidity event. The key is you're going to want to be aligned with the private equity sponsor, so when they get out, you can get out. That's kind of how that works. So I got a lot of questions coming at me. Let me do a couple more here. All right. This actually, a PE sponsor may broker an internal brokerage sale from one PE firm's funds to another. Please provide your perspective on this type of transaction. So we've seen this quite a bit. A private equity firm owns a company like, for example, Alera. Genstar owned Alera. Genstar raised another fund, and their first fund was, coming to its drop dead late date, I guess. So you have to, you can't stay in the fund forever. But they love the Alera asset so much that they sold it to another fund that they owned. And so in that case, the investors basically had the chance to get some liquidity if they wanted, or to roll over into the new fund. To me, those types of deals, I mean, I guess you could say, is the buy sell, it's not a marketed deal, so is the buy sell correct? I think they tend to get them right on the pricing. But what it does is, you'll notice that when a private equity firm does that, to me, it gives them confidence in their investment. They want to, hold on to it because they don't think there's better they could sell it. They don't think there's a better opportunity for better deals out there. All right, so let's see what else we got here. Oh, here's a good one for us. What % of the transactions are you representing the seller versus the buyer? So, our primary business is representing the seller. So, last year we did about 53 sell sides. The 50 buy sides, that would be a private equity firm hires our team to do financial analysis or diligence for a deal they're looking at that we are not on the sell side for. So I would say, our primary business is really, we're really a seller. We represent sellers. On the buy side, if someone wants to look at a deal that we're not representing, they want us to look at it and do the financial analysis, we'll do that. Here's an interesting one. What do you make of Lockton not being on the list of the 50 plus buyers? So yeah, Lockton is traditionally not an acquirer. I don't think that's a negative at all. That's not their thing. They don't need it. It's Lockton's been super successful without having to do acquisitions. So it suits them, and I think they're probably, they're doing the right thing by that. Okay, let's see what else. All right. Can you speak to the Gallagher AP deal and why, and what do you think the impact will be on the market? Well, if you see this little QR code on the bottom of our screen, if you I don't know, take a picture of that, that should take you to our Gallagher assured case study. To me, I think it was the best deal to take place in the past decade. And I'll get flack for saying that even internally because we debated it. But I'm pretty staunch about it. It was a great deal for Gallagher. They essentially bought $1 billion of EBITDA. That would have taken them 36 years to do. They bought it for really 11.5, 12 times. So they're getting, 8% expected return plus 6. They're getting 14% returns unlevered. Now, Gallagher also borrowed half of that purchase price at 5% interest rates. Spectacular deal. Now, the other angle would be, some people would say, well, what about for short shareholders? I'm sure assured shareholders, would love to have gotten 17 times EBITDA, and maybe they only did get 13, 14, 15, depending on whose perspective. But what assured shareholders got? They got all cash, complete cash. That was the only deal where everyone got all cash. So it was a great outcome for both sides. How does that change things going forward? I think you'll see more strategic deals getting done. I think you see some of these large private equity-backed brokers sell to publics. I think it's I think it was a really good deal, all around. You think about Short at $1 billion EBITDA, they didn't have many people they can go to. You couldn't do a private equity deal that size. So you had maybe Aon already did a deal. Marsh had just done a large deal. So you had really Gallagher or Brown. And for those who know the history between Brown and Brown and Assured, that wasn't going to happen. So I thought it's a great deal, and I think it will set the pace for large deals going forward. Let me see. I think I have one more here. All right. Okay. Okay, this is actually, these are really good ones. When you say, here's a good question. When you say multiple of EBITDA, are you referring to multiple of normalized EBITDA? I guess we would call it normalized. We call it pro forma. So I consider it our version of EBITDA. When someone hires us, we try to say, okay, what's the economic earnings power of this business? And so, for example, let's just say you're an agency and it looks like you have a $1 million EBITDA, but you also have a producer you just hired, and with benefits, all in costs, you're paying him $100,000 a year, and that suppresses your EBITDA because it's an expense. Well, is that really an expense or is it an investment? This is very debatable, and for the buyers on the call here, they'll say it's an expense. We would say it's an investment. So if that were me, if I were representing somebody, I'd probably say, well, we really have $1.1 million EBITDA. So you might call that normalization. We call it pro forma. There's 1,000 adjustments we're making, but I like to figure out what's the economic earnings power of this business on a go-forward basis. It's highly debated, and we just saw, Gallagher's deal before where we had 5 different versions of what the EBITDA was. So eventually you come to what ultimately matters is that final purchase price. But when people really rely on the EBITDA, they're saying, hey, I sold my business for X amount of EBITDA, a multiple. To me, that doesn't mean anything. And let's see, another question is, all right, you said 11.5 times multiple EBITDA, but we've had people discuss with us 15 to 17 times EBITDA. And we hear that a lot. We actually lose assignments because people are told they're going to sell their agency for 17 times EBITDA. If you have an agency with $1 million, $2 million, $3 million, $4 million, $5 million EBITDA, you're not selling it for 17 times EBITDA. And here's why. Let's go back to that math. So if I pay 17 times for your $1 million EBITDA, I'm getting a 6% return. And you're growing, I don't know how much you're growing at. So what am I at, a 9% return, but I'm going to borrow at 11%? It's just not happening. Now, even the large deals, I think $1 billion EBITDA, you can't get 17 times, obviously, as by the Assured deal. I think probably over $300 million, you can't get 17 times. So now, if you have 100 million of EBITDA, can you get 17 times? You might be able to. You know why? Because there's opportunity to double the size of that business. Keep doing deals, you can grow it. So I think smaller platforms could get a higher multiple than some of the mega large platforms. But yeah, I mean, it's frustrating for us. The multiple is, if I tell you I'll buy your business and I'll pay you 17 times, but you got to swim across the Atlantic and climb Mount Everest in the same week, what did you really get paid up front? So we're focused on the upfront, and that upfront is, from us, it's around 9.5 to 14, 11.5 is right there in the middle. And I'll take, now I got Mindy checking us out here. Let's see, hold on one second. Hold on one second. I'm just trying to I'll pull up our last and final question, and if we didn't get to, we'll get to more. Actually, this is actually pretty interesting. I got 2 more. What are the main challenges that occur during the due diligence process, and how do you mitigate them? Great question. So in the mergers and acquisition world, 50% of all deals, when you agree to a deal, so someone makes you an offer, you shake hands on it, you sign a letter of intent, 50% of those deals never ever close. 50%. Last year of the LOIs, 95% of our closed. The 5% that didn't would be sellers getting cold feet, something happens, something changes. So not knowing what you're getting in, you're not understanding all these things, you're not doing diligence before you start the process is probably the problem. So what problems can you run into? Not understanding what you had there to begin with. But let's just say you go down the path and you've agreed to a deal, you did know everything that was there. But you lost your major top 10 accounts or something between LOI and close, or someone producer left, something like that. That could be an issue. We really don't see that often because we're trying to do diligence up front. And then the final question would be, you spoke very briefly about people and culture of the sellers and buyers. Can you elaborate? Sure. I mean, it's a culture. If you do a deal just for the money, I think you're probably going to be miserable. So, I think you want to get the money right, but you really want to get the fit right, because most of our clients, they're not retiring. They're continuing on with these new partners. And, everyone has a different preference for the type of partner they want. And immediately, when we have our management meetings, you could see right away just the connection between people that people have. So it's not necessarily about the strategy of the business; it's about how the people fit. So I think the people part, is way more important than the economics. Although we're going to focus on getting the economics right. So I could see we've run out of time here, but so look, I'd like to thank everyone for joining us. We really appreciate it. We have our emails right on the screen here. If you have any questions, we will answer them, and we will make sure we get to the questions. We'll shoot you an email that we didn't get to. Also, if you want to read about the Assured deal, Gallagher deal, I think it's a great piece, or about the M&A tariffs, just take the QR code and you'll get to those pretty quickly. Otherwise, thanks for attending. We'll see you next time.
Yeah, on behalf of Business Insurance, thank you everyone for joining. Have a wonderful holiday weekend.